Well, that last stream was super interesting. That last stream is, I don't know how you're going to top that. Chucklefish, Raw Fury, and Fellow Traveler. Bam, that's a combo right there. Anyways, what's up, everybody? I'm Indy, and welcome again to another session. This is our which one? 1, 2. This is our third session of the day. We are talking with Martin McMillan, and he's going to talk about financing LTV cycles and why genre matters. So I'll leave it up to you, Martin.
Great. Thank you very much, Indy. So pleasure to be here. Thank you for tuning in, everyone. I'm Martin McMillan. I'm the founder of Pollen VC, and today we're going to be talking about financing LTV cycles and why genre matters. So I don't know if you guys can see my slides okay from here. I don't know, Indy, if you're able to share the different screen. There we go. So why genre matters and in financing LTV cycles, right? So let's kick off. I'll just give you a very quick intro to Pollen VC, who we are and what we do. So our kind of mission and why we do all these seminars like we're doing just now is basically to improve the financial literacy of mobile game developers. Too often we find that particularly indie game studios are great at making games, getting better at user acquisition, monetization, but very often the financial piece is kind of is overlooked until way later in a company's life cycle. So that's one of the things we're trying to kind of address. As a business, what we do is we provide credit facilities to gaming studios, which enables them to scale up using paid UA channels without having to dilute their equity. So typically, it's a model where you use some equity and some debt as part of an overall kind of mix of capital. But it's a very, very capital efficient way to grow a studio once you have figured out an ROI positive formula for user acquisition. Okay, so let's get back to basics. So in terms of launching and scaling games, there are obviously a very few famous examples of games that just launched and went to the top of the charts and viral. But for the rest of us mere mortals, paid acquisition is just a really, really important part of being able to grow a mobile game. It's not that's not exactly a big secret, right? It gets baked into the plans of virtually any gaming studio, kind of right from the start, from the early days. Again, as a finance guy in gaming, we think about user acquisition just in a really, really simple format, which is basically the concept of the machine. So do I have a UA machine? So what's a UA machine? So first of all, the machine, as we think about it, is just like, do you have a formula where you can put $1 into paid acquisition and then measure everything such that you get a lifetime value or a result, a financial result, where you're getting more out the other side? That could be putting $1 into user acquisition, making $1.50 after 90 or 100 days of lifetime value, whatever. So effectively, this formula where you can put meat in and get sausage out the other side and keep cranking the handle in terms of user acquisition. And that's, to be honest, this is where most people kind of fall down. They just keep, they keep trying paid acquisition trials, and the acquisition costs are just too high to support it. So a lot of people kind of fall over on the first hurdle in terms of, do I have this machine? But if you do have the machine, then attention is going to quickly turn to, how am I going to fund the machine? Where am I going to find the capital to put into this machine to get this financial return from paid ads? And that again, we'll go through some of the different ways of funding this. And thirdly, how do I know when my machine is running at full capacity? So these things are not infinitely scalable, and acquisition costs rise, LTVs crest the more you buy. So it's basically it's effectively a deep dive into your own kind of demand economics, and to see what the where the effectively there's no juice left in the trade, and you should stop spending money on paid acquisition. So again, as a intersection of finance and gaming is where we sit, and we're just really thinking about a fairly simple formula of, how much do I have to invest? What's my CPI or CPA, whatever the acquisition mechanic is? And then how much out? So what's the ultimate lifetime value, let's say? And then how long does it take? So many people overlook the how long does it take and just get focused on the headline metrics. But the time here is super important. We're going to dive into why that's the case a little bit more shortly. So Another way to think about it is just as a recipe. So you invest $1, you get $2. How long does it take you to get the $2 out? Is that 30 days or 180 days or 360 days or 720 days? And you obviously need to track with all the metrics and analytics available to the studio what your recipe looks like. Your recipe, by the way, is going to look different in different geos, all sorts of different audience parameters and so on. But what we're talking about here is just a high-level, broad brush approach, trying to understand the sort of the zoomed-out high-level metrics. So first of all, what we want to do here is to start to build a curve. The things that we care most about after spending our, let's say we're spending our $1, is the first thing we're going to focus on is when do we break even on that $1? Or, first of all, do we break even, and if so, when? So in this graph here, it's again just very, very simple kind of mechanics. So this is effectively illustrating the P&L of a user or a cohort of users. So we're starting at 0. They start to spend money over time. Around about day 120 is when I have enough revenue, whether that's in-app purchase or in-app advertising revenue, to break even on my ad spend. So I've invested my $1. When do I get my $1 back? 120 days. That's the ROAS period. And then ultimately, obviously, players will continue to spend after that, which is ultimately the profit you're earning. So in this case, you spend 1, and then you go on to make you break even on 120 days, and then ultimately you should achieve a lifetime value of around $2, but it's going to take you a year to get there. So again, just a really simple example. And what we're then looking at is basically, because this isn't just about ROAS, this isn't just about breaking even on the ad spend. If it was, the only people that would be making any money would be Facebook and Google and the big ad networks. So this is about your profit only kicks in obviously after you've broken even. So we're gonna try and create our investment formula from this simple example. So basically, we're making $1. So our acquisition costs $1. We break even D120. We get $2 out D360. So our profit is $1, right? So we make 2. We had to spend 1 to acquire the user, so our profit's 1. But it's taken us 360 days. It's taken us 12 months to get that LTV out. So what I want to do is I want to create a formula where I can look at the monthly return. So I don't want an annual return or a D90 return, whatever. I just want an annualized, I want a monthly return so I can compare it against different genres and different opportunities to invest within my business. So I'm just going to take, it's 100%, I divide it by 12. So I'm getting a monthly return on my ad spend of 8.33%, 8 1/3, right? So that's basically, that's your investment equation on which you can base user acquisition decisions and how you're funding these and all the rest of it. So very important to break this down to the concept of a monthly return. Now, and onto the kind of like the main topic of what we wanted to talk about today. So the reason the LTV horizon is so important, because all sorts of different games have different genres, right? So we're gonna look at a continuum of really short duration LTV up to really long duration LTVs, and these are just obviously just example kind of numbers, sort of roughly where we see some of these things kind of work. So take one end of the bookends just now. So you've got hyper casual gaming. It's super fast, snackable, break even quick, and then toss the game out within 30 days, right? So we're in this example, we'll say, hey, we're going to break even on our ad spend. So we invest the 20 cents to buy a user. By day 5, we've served them enough ads to break even on our 20 cents. And then by D30, we've recovered our LTV. So all of our LTVs, where just basically users are pretty much stopping playing, and we're going to get, whatever, a 20% or a 50% return in that month. But basically after D30, the game's pretty much dead. Of course, some people go on to play forever, but generally it's a very, very small percentage. Mid-core, hybrid casual, there's all sorts of games in this genre. Typically it's around a 60 to 90 day break-even period on the ad spend. But the users will monetize for longer. They might go on to monetize for up to a year before the spending just kind of peters off, and they don't play so much anymore. And then if you look to the ever popular merge or some of the puzzle genres, these have generally got longer break-even periods, right? So we work with, and we're seeing some games in this genre that are averaging out about a 270 day break-even period. So they spend money on ads, they won't break even for 270 days, but we expect those players to go on for at least a year, if not, really thinking about a 2-year LTV. So it's much, much longer horizons that they're thinking about. And then right at the other end of the spectrum is the social casino genre. So where people, you can spend up to like $25 to acquire a user for social casino, but it's like the gift that keeps on giving. You might wait, or you probably will wait more than a year before you break even. It could be a year to 15 months, even 18 months to break even. But then a very kind of like loyal user base over multi-year periods. So that you might measure LTV over a 3 or even 4-year period or something like that. So and when setting out to kind of figure out what kind of studio you are, how much capital you're going to need if you want to get to any kind of level of scale and so on, thinking about this stuff is really important, because it sort of moves the needle for how you fund and how you grow your business. So one thing in terms of so what you're really talking about doing is financing LTV, right? So financing LTV is really thinking about, if I have to wait days or weeks or months or years, whatever, before I'm going to break even, how am I going to finance this? And we're going to dive into a couple of examples, but you need to be able to fund, however you do it, you have to fund these cohorts until they start to mature, they start to break even, and they go on to make a profit. So this is, the duration here is super, super important. The other thing to remember is studios are always really really on P&L, just like when do you actually clock the number into your metrics or whatever, and often forget that the P&L as an accounting metric is totally different to when you get the cash. So you may say, hey, I made $1,000 on IAP revenue yesterday, but in reality you won't be paid that money until maybe 67 days later. Or if you're doing advertising and you're using monetizing with one of the ad networks who has net 60 payment terms, it could be 90 days before you actually see that money. So you really need to think about that when you're doing your financial planning and financial modeling, about how much, when do you actually get the cash out, and then you can reinvest it back into your equation. And then lastly, you need to spend sustainably if you're going to scale up. So you say, I want to go from 1,000 a day in spend to 10,000 a day in spend. You can't start chopping around and spend all your money and then do nothing for 2 weeks and then start to spend again when you get paid. The algorithm, the ad network don't like sporadic spending. They like sustainable spending that can be sustained over a long period of time. So again, in order to not run out of cash and to be able to do it in a controlled way, the sustainability point is pretty important. Right, cannot stress this enough. Focus on cohorts. Don't look at your daily revenues versus your daily spend, all of these things. That could be hiding a whole myriad of different issues. So really focus on everything at a cohort level. Invest in a mobile measurement partner that's going to give you the best kind of approximation of the cohorts, and then start to model the behavior on a cohorted basis. So here we're going to look for, again, a fictitious example of let's call it a merge game cohort, and how long it takes to get to the various different points, right? So in this example, it's a longer duration game. It's people are expected to play for a longer time, but in this case, the studio is not expecting to break even until D270, which is like 9 months. But they expect to make an 80% return after the second year, right? So then what we're going to look at is the P&L, so the profit and loss of the cohort. So let's say it cost me $5 to acquire the user. It takes me 270 days to get my $5 back. And remember, it's not the cash for it. The cash might come even later, but on a P&L basis, I'm going to break even 270, and then my profit is earned between day 270 and 720 as users continue to play the game but gradually tail off over time. So it's quite a long threshold. It's a big investment up front, and it's going to take a long time to recover that. So if you're funding through equity, if you're thinking, okay, I need to, I'm going to build my financial plan, and I'm going to basically just keep spending. So I want to go and spend, 10,000 a day, 10,000 a day every single day, because I reckon I can scale my spend from 1,000 a day to 10,000 a day over maybe a 60-day period, and I want to do it sustainably. So what I need to be thinking about here is, how much cash do I need to have just sitting there in the bank in order to spend the 10,000 a day before these cohorts start to break even and start to return some money back into the company? And if you think about it, what we've, I've not put any numbers in here deliberately, but just the curve to basically say, you're going to go very, very cash negative. And then when that bottoms out, with the trough of that is basically going to be your minimum cash position, which is going to be, potentially minus, hundreds of thousands or millions or tens of millions, depending what, what lane you're in. And then only gradually then it's going to come back and start to return. So in this case, like, you want to spend $10,000 a day, but your break even isn't till day 270. The kind of stuff you need to model out and is like, okay, how cash negative is this going to go? In this case, we have spent $2.7 million before our first cohort has even broken even. So think about it like this: it's January the 1st. We start our aggressive 10 grand a day spend. It's basically September before that first cohort you acquired in January the 1st even earns the CPI back. So this is going to be a pretty capital intensive game, which is why to some extent you see companies raising massive equity rounds, because so much money ends up in user acquisition. So now we know how much we need. Let's look at different financing ways, because for a very long time in gaming, it was really simple. It was either I'm going to self-publish. I want to do this myself. I'm ambitious. I'm going to go and raise a big bunch of venture capital, and that's what I'm going to deploy into user acquisition as well as making my game. And what's happened, the other option is like, hey, this is such a capital intensive business, I don't have the balance sheet or whatever to do it. So I'm going to basically go work with a publisher, and I'm going to give away 50 or 60 or even 70% of my revenues for them to effectively finance these cycles instead. I think the thing to bear in mind for studios who are considering working with a publisher, it's just basically, who do you want to be? Do you want to be a self-published studio who has a shot at an M&A transaction, or are you happy to just make great games and let someone else take care of them? Either option is totally fine. But we ran some analysis and some publicly available M&A data last year, and basically we wanted to know the primary business model of studios that got sold between the 1st of January 2020 and I think it was the end of May 2021. And the results were really interesting. So 83% of all the M&A activity by volume was self-published studios that got sold. 15% were publishers who, publishers of third-party titles, and only 2% of studios that got sold were studios that relied on someone else to get their games to market, right? So if you wind that back, basically, if you ever want to sell your company, you need to learn to self-publish. And also in terms of raising venture money, VCs are very unlikely to invest in you unless you have an aspiration to self-publish. Maybe you do 1 or 2 titles through publishers to learn the ropes, but I think the aspiration has to be towards self-publishing. So anyway, back to the different kind of models. So venture capital is the obvious one. You give away a stake in your company and you raise millions of dollars or tens of millions of dollars to your business, and off you go. The next is factoring and revenue-based loans. So factoring is basically it's the idea of selling an invoice, right? So it's a little bit different in mobile app and gaming, but that's basically saying, look, I've got this money from Apple that's coming in 60 days. Give me some money against it now. I'll pay you, and I'll give you the rest when it comes through. Well, revenue-based loans have been more common in recent years, where people say, "Hey, I'll lend you some money. You put it into user acquisition, and then I'll take a skim. I'll take a revenue share off the top until my loan's been paid back with a fixed fee." These sorts of things, particularly revenue-based loans, work fantastic for SaaS businesses and recurring revenue businesses. Not so good on mobile gaming businesses, particularly on free to play, because the profile is different. Bank facilities. So very often you see people saying, at a certain level of scale, typically about $1 million or more, they can go and get a credit facility from the bank based against all their invoices or the money due to them. Or the other thing the banks are very good at is venture debt. So typically venture debt is a like a term loan. And it's always generally attached to a venture capital round. So typically, if you've raised a venture capital round, you'd be able to borrow roughly 20% of the amount you've raised in equity as debt on the end of it, which generally is repaid or amortizes over like a 3 or 4 year period. Publisher, obviously, you know, a lot of studios end up with publishers. Some because they just don't want the hassle of user acquisition. They're happy to, you know, just make great games. And then some end up with a publisher primarily because they're either not able to do user acquisition or they're not able to fund it. And obviously that's going to have ramifications for their business down the line, but it's something to be cognizant of. And then there's non-bank revolving credit facilities. So that's, you know, that's the kind of thing we do at Pollen. So we basically look at and re-verify all of this every day. So we look at basically the amount of money that's trapped up in the system, the accounts receivable, the money you've earned but not been paid, and then the other side of it is how we estimate on a daily basis the residual value left in your live cohorts, and you have a very flexible revolving line of credit against those two assets within your business. So typically that will just grow with you over time. It never needs to be repaid until you decide to, you know, to ultimately sort of wind down the facility. So let's look at, you know, again, there's no specific numbers in here, but the directional trend is kind of the same. So if I'm saying I'm going for my, you know, my $10,000 a day spend, if I do the whole lot through equity, I'm going to need X amount. And if I do some of it through revolving credit, then I'm going to need less upfront money to achieve my goal. And the reason for that is as you're earning revenue, you're borrowing against that, and then you're reinvesting that money back in. So you're reinvesting your own funds back into user acquisition, so you don't have to go and, you know, raise an even larger amount of equity and to use that. So generally, it's it provides studios a lot more kind of efficient way of funding rather than just pure equity alone. One of the things we do at Pollen is we work with studios once they've got some decent metrics and they've got some decent revenues on the board. We actually work with them and build these financial models that go super deep and granular in terms of figuring out the different ways from where you are to where you want to get to. So there's a few other things for as you're building these financial models and so on to try and model out. There's a few other things to remember. So first of all, in terms of monetization, right? This is not the sort of user acquisition team saying, "Hey, I'm making X cents a day in P&L." This is starting to think about if I'm going to actually fund more user acquisition on the back of this, and when am I getting paid? So if you take take the start of the month and the end of the month. So take the month of January, and every day in the month of January, you're serving ads, for example, and you're earning money. So you can see exactly what your sales are. And you also know roughly when you're going to get the money. So the shortest paying ad network typically pay around net 15. So net 15 means 15 days from the end of the month. So if you think, if I take my midpoint in January and then 15 days from the end of the month, say the 15th of February, I'm going to be waiting on average 30 days for that cash to hit my account. And then it goes through different folks have different payout terms, and ultimately the longer one. So if I'm on some of the longer paying guys like Unity Ads or Vungle or IronSource, typically I'm going to be waiting net 60, so 60 days from the end of the month. That's going to be a full on average, a 75-day wait after I've been serving their ads before the cash hits my account. So that needs to be factored into your calculations. Then on the other side of it, you think about user acquisition facilities. And obviously, initially you start off with these things on credit cards. And then over time, what you end up doing is, the ad networks will give you a credit facility, which is great because as soon as they do that, it's a period of 30 or 45 days of risk transfer from you onto them. So if they're prepared to give you these facilities, you should use them and keep them maxed out. And again, typically it's going to work in the same way. So anything you're spending in January, you're going to get a bill at the end of January, and that bill is going to be due at the end of February. Sometimes it's a little bit longer, sometimes it could be shorter. Typically it's around the end of the following month that you need to pay the bill. Now, why this is really important is this all feeds back into your, thinking about your genres and your break-even period. So here, if I'm, it's the month of January, so I spend my 10,000 a day. So I've spent 300,000 in January, and then I have got to pay the bill at the end of February. Well, that's going to be a problem if my first cohort in January doesn't break even until September. So these are the sort of things to think about. So what can happen here is you might think, hey, I'm recovering my money okay, but actually I'm going to have a massive cash shortfall when it comes to pay the bill on my credit line. So all of this stuff needs to be factored into the model to make sure that you have enough, enough capital to continue to fund. Otherwise, what happens is you run out, your credit line gets dropped, all of your user acquisition goes to zero, and it takes some time, as well as having to sort out the financial aspect. It takes time for the algorithms to basically get up to kind of speed again. That's why the consistency of spend is really, really important. So we're going to talk about, I think the key takeaway from this is, and think about this as you're planning the games, planning the different genres, and figuring out what sort of games you want to make and what sort of investment horizons you have. Do you want to go for something super long that's going to be very capital intensive to get there, or are you happy on making hyper casual games, figuring out that people are going to you're going to break even in 5 days or whatever it might be. And I think the point, because we see a lot of the kind of M&A deal flow as well as a company, and what the directionally, if you look at who's getting acquired and why, it's always the studios that are building longer term franchises. Very, very few hyper casual studios ever get acquired. Maybe the hyper casual publishers, if they've got a good deal flow of studios to put through the put through the mill, but generally where the big money is in terms of M&A activity is in games who've got like longer duration. So people where the players can be playing for months or years as opposed to days or weeks. And obviously the longer duration, the LTV of the game, the more capital you need to have to finance it. So I'm going to move on now into how to actually fund the user acquisition spend. And so again, this is like thinking through the different options, right? And this should not be a kind of an emotional decision. It should just be a really, really dispassionate decision based on sort of rational economics, right? So we have this idea at Pollen of the capital stack, and basically what if you go back to thinking about your user acquisition machine, if the user acquisition machine is working, and then how am I going to fund it? So rationally, what you should want to do is to start, for the duration of the opportunity, whilst the well is still open for drinking, you should want to start with the cheapest source of capital, and then work through, progressively more expensive sources of capital until it just doesn't, typically what will happen is the economics just dry up. Your acquisition costs will rise, your LTVs are going to crest over time, and it just doesn't make sense to do. And now, how far you get through that stack is just going to totally depend on your own economics. So let's start with the cheapest one. So the cheapest one is free. So if you have Facebook or Google or TikTok or whoever offering you a credit facility, that's basically, as I said, that's a risk transfer of LTV recovery from you to them. They're giving you effectively 30 days or whatever free credit to spend money on their platform. And the reason they do that, of course, is they want to keep you, they want to keep you on the hook. They want to keep you on the drip. And they have to do so at a certain level to be competitive. So the credit lines from the ad network, because it's free, is basically the cost is zero. And if you can make that 8% monthly return, whatever, then great. The next is cash at the bank. So if, for example, you've got an existing game that's just chucking off a load of free cash flow every month, and you've got that money sitting in Silicon Valley Bank earning you 25 basis points a year or something, then you could say, well, look, provided no other part of my business needs that cash, maybe I should take my own cash, and instead of making 0.25% a year, I can take that and I can put it around my ads formula and make 8% per month. Now, there's a real distinction between free cash flow that's just sitting there in the bank doing nothing and venture capital that you've just raised, right? So if you've just gone and often done a $3 or $4 million seed round, whatever, the VCs have put that money in for you to build products, go and hire people, license intellectual property into the game or whatever it may be. That's sort of an at-risk activity. They're not, or they shouldn't be putting money in just to allow you to put it around the track with Facebook and Google ads for 60 days. So there's a difference between, real free cash flow and then venture capital that just is sitting in the bank waiting to be deployed into something more risky. Next is credit cards. We used to see this a lot a few years ago. We see it actually very little now. People using credit cards and juggling interest-free periods as a way of trying to push out the time frames in order to run their UA on the back of it. People still do it a little bit. The primary reason is to earn air miles, because obviously if you're spending particularly large sums of money, you're earning a lot of air miles. And I know some people will probably never pay for another flight in their lives, who have dined out on the credit card trade on Facebook ads. But again, it's not really such a thing. Lines of credit. So basically, this could be like a bank facility, or it could be a non-bank facility through someone like Pollen. These are these elastic credit facilities that are secured against normally receivables, which is just the money that's trapped up in the bank of Apple or Google or Facebook or whoever. In our case, we also lend against these residuals because we figured out a way to price them. So that should be, that's revenue based on your exact data that's refreshing every day. So that's typically next in the stack. As you go further down, you get into revenue-based loans. So these are the loans that are repaid by a future revenue share. I lend you money for user acquisition, you spend it on you, and I take a percentage. So these are against future receivables. So typically, because it's less certain, that ends up being more expensive than a credit line, which is your actual receivables and residuals. And then right at the bottom of the stack, if you've exhausted all of these and the user acquisition trade is still red hot, then there's venture capital funding. So VC funding obviously is dilutive. You're going to give away shares in the company. So typically, we'd always advocate don't look at VC funding for user acquisition until you've exhausted the other options in the stack. Now, by the way, that is not in any way a suggestion say don't it's bad to look for VC funding. Absolutely not. So these different alternative sorts of financing, the debt financing options, always sit alongside venture capital. It's never an either or. It's always you have both different things in the mix. And the way to think about the mix, it's like the concept in finance of capital efficiency. It's using the right form of capital to deploy in the right sort of projects within the company. So if you said, I need $1 million to go, and I've got some crazy idea, I want to build a game that has some crazy mechanic, whatever, and I need $1 million to hire a team and to build a prototype and buy some users and see if it's going to work. Absolutely, that's equity funding. It's high risk, high reward kind of financing, and equity is exactly the way to fund it through diluting some of your shareholding. On the other hand, if you said, look, I've got this copper bottom formula that I can put $1 into Facebook ads and I can make 50 cents within 30 days, then that you should be funding that through debt instruments instead of equity, because a very low risk profile and high degree of certainty, in which case it's just a more efficient way to fund. So the other thing is, and sometimes it's really frustrating when you see companies go and raise these massive rounds just for user acquisition, when the founders of those businesses have effectively, to some extent, needlessly diluted themselves. So they're just, they'll take less off the table on the day, and it's largely because of a kind of lack of understanding of how to use different instruments. So that's an overview of what we call the capital stack, and hopefully useful as a reference point. One of the other things, and I'm not going to go into this now, but I would urge you guys to have a look at it. So I mentioned that one of the things we really care about as a company is transparency and helping studios arrive at the right financing decisions for their business. So we have a section called calculators on our website, and we have just like a sandbox environment. So the one you can see is basically it helps you for a free-to-play game. It helps you calculate ROAS periods. It helps model the LTV curves, and then at the top there's a bunch of other tabs as well. So you can model cash flows and all sorts of different things on there. So that's just like a super simple sandbox. We don't ask you for any data to connect up to it or anything. It's just you can put in your metrics and model some scenarios. You can see if you've got this this ROI positive curve, and if you have, we'll help you try and understand ways of financing that and what the possible outcomes could be. So feel free to check that out. It's on our website at pollen.vc. And the next thing I was gonna just draw your attention to, again from the website, is there's a lot of talk of different financing models, and there's still, unfortunately, a lot of kind of uncertainty. Some people treat these alternative models with a bit of sort of trepidation, and generates a lack of understanding. So one of the things we did is we created this guide, which is hopefully pretty accessible. Some parts we got a bit more technical, but it basically tries to articulate all of the different models for funding user acquisition, and to break down some of the pros and cons of each of them. One of the things that we're very, very hot on is, I mentioned the transparency thing is very important to us. So sometimes when you see different forms of financial product, the lender behind them tries to obfuscate the true costs of financing. So with any time-based capital product, you can always break these cash flows down to an interest rate. And if you went shopping for a new credit card or a mortgage, whatever, you would be looking at the interest rate, and you would want to find probably the lowest interest rate, because you're comparing them all on an apples with apples basis. So unfortunately, in the world of UA financing, it's not compared on an apples for apples basis. So as a company, we always quote on a very simple, straightforward interest rate basis, just like a credit card, or like a bank overdraft or something like that. But what we have created here is, so for factoring, which is generally done on the fixed fee of an invoice value, or for revenue-based loans, it's an agreed revenue share without certainty about what the numbers are. We've created some calculators to help you break down those models to an interest rate, and then only when you have the interest rate and you understand the different nuances of the models and so on, then you can make a most informed comparison. So that again is just available to download from the website at Pollen VC, and hopefully that's a useful resource. So that was kind of it in terms of my presentation. Hopefully there's a few different things to think about there. I mean, as a company, as I said, we always think about we look through everything through a financial lens at everything, and the user acquisition piece is such an important part of success in a mobile gaming studio, and particularly when you're setting out to think about what kind of games you're creating over what sort of genre, then figuring out what the life cycle of the game, the lifetime values of the users may be. Are you measuring that in days, weeks, months, or years? And to factor that in terms of your ambitions as a studio, what do you want to do, and what sort of games you want to make, and for who, and then how are you going to finance that? So hopefully some interesting content for you there. Please reach out and connect with me on LinkedIn, or follow us on Twitter, usual social channels. And I'll hand back to Jay, and then see if there's maybe any questions that came out of the presentation. Happy to answer anything.
We've got a few, and if I missed any, then Dan and I run around behind the scenes trying to keep everything somewhat organized, so bear with me. But yeah, I mean, one of the first ones, and this is interesting because when people are talking about financing typical businesses, everybody's like, oh, go to the bank, get a loan. Is that even remotely feasible in our industry to do some of this financing?
So it can be. Typically, in the US, small business loans can be pretty expensive, and they're also typically backed. You have to give up your own FICO score in terms of trying to secure the loan, and the loan is ultimately guaranteed by you personally, right? Not in every instance, but in a lot of instances, your typical small business bank loan has got a personal guarantee. So you've got to figure out whether you want to bet the house on your Facebook spend, right? The other thing is that bank loans are typically done on a term basis, right? So I borrow 100 grand, borrow 200 grand, whatever the number is, and I pay it back in fixed installments over a period of time. So it's amortizing over a period of time. It just goes, loan balance goes down to zero over 3 years or something. Now, if you were looking to borrow money for user acquisition, you don't want to take $1 million loan day one and then have that money just sitting in the bank and paying interest on it. And so what you should prefer to have is something that you can just dial up and down as you need it. Because otherwise, you just take, unless you can invest that $1 million day one, put the whole thing into user acquisition that's going to make the return you expected, you're going to have a mismatch in on your cash, right? So we have a blog post that talks about using venture debt to fund user acquisition, and we highlight some things on there around. There's typically a mismatch. So for our industry, rather than a straightforward term bank loan, a credit facility that can be upsized and downsized very quickly in line with user acquisition is typically a better bet.
So this is one that we get a lot, and to the point that I made a flowchart of like, do I need a publisher? And one of the things was, are you making a free-to-play game? And then the answer was just yes. I mean, there's somebody's got to fund, this user acquisition pipeline that is required to do a free-to-play game. For a lot of indie devs that want to get the stuff out there, and they've gone and they've jumped into a free-to-play model without realizing how difficult it is there a way that they can start their own user acquisition, given that they may not have access to hundreds of thousands of millions of dollars? Because especially, a lot of our guests are from developing countries, and that's not going to happen. What is your advice to those teams?
So, well, I'll go back to something that I said in the presentation, which was the analysis we did of the M&A data, saying 83% of the companies were self-published studios that got acquired, 15% were publisher, and only 2% of studios relied on a publisher. Now, so my view is basically like in terms of the publisher revenue share is largely disproportionate for the value they add, right? That might be controversial, but whatever. If you look, and we work with a bunch of studios who have previously published games with sometimes big publishers, and they said, like, when we strip it all away, like a large part of the value that they're adding is basically they are renting me their balance sheet and doing user acquisition and fronting the cost for it, but on the basis that they know that money's going to get returned. If they don't, they're not going to take the risk, right? So they're not really taking a risk on it. You're just renting the balance sheet. And the other side of it, they're programming Facebook ads or Google ads or whatever, right? And taking, let's say, a 50 or say 60% revenue share. Now, if you strip it all down, if you say, like, maybe you're happy for someone else to just take care of all of that. You don't want to try and sell your studio. You just want to make great games and get paid for them. That's totally cool. Go work with a publisher. But if you're more ambitious and you want to have your name on the door, be remembered for something, as opposed to just another game just spat out the cannon by the publisher, one of 20 games they might be publishing at the time, then learning how to self-publish is really important. Now, in answer to your question, you're always going to need to have some money to shunt the ship out of port, right? And this is why the whole thing of genre is super important. So, if you're a hyper casual developer and you have, let's say you think you need $1 million to blow this game up the thing, you just don't have $1 million, right? But maybe you have 30 or 40 or 50K from existing games you've published. You can spend, if you've got very short break-even periods, if you're earning the ROAS back very quickly, which obviously you do in hyper casual, you can spend $1 million off a 50K budget. If you just borrow and you just recycle this money around the track, you can spend a huge amount in a very quick way if you're smart about the financing of it. Now, if you said, hey, I've got 25 grand or a 50 grand UA budget for my merge game that's going to take 9 months to break even, that's going to be a hard one, right? That's going to be, you might have great metrics for it, but it's going to take, given that it takes a long time to get there. So any kind of debt instrument to fund that, it's going to move the needle a bit, but it's going to be hard. So at that stage, you probably, if the metrics are good and as good as you think they are, you should go and raise some venture capital to put into it. So it's that's why the duration, the time to break even is so critical, and it's really important to think the stuff through upfront in terms of what games you're doing, and then you plug in the financing strategy behind it.
Are there particular places to go to find? I mean, so we have like the publisher list, but we don't have a VC list. Are there places to go where developers can find, VC firms like Pollen and see what their options are and see if they're a good fit for, what you're looking for?
Right. So I should clear something up front. So our name as Pollen VC happened by accident. So we're not a VC in terms of we don't make equity investments, right? We provide these revolving credit facilities. The very quick story behind the name was originally we were Pollen, and then our strapline was Velocity Capital. But unfortunately, right? Unfortunately, we got into a few trademark spats over that. And it seemed because our URL was pollen.vc, people just referred to us as pollen.vc, and it just kind of stuck, right? So it's not, so we often get asked that question in terms of, hey, you're not like a normal VC. It's like, no. So we're debt investors. We provide these really quick revolving credit facilities. And most often we sit behind venture capital investors who we work really synergistically with. They provide a lot of our deal flow, for example. And the studio then has a mix of equity and debt in their business.
All right. So obviously, part of the reason that you need to spend all this money on UA to get started is so you get, like you said, you're shunting it out of the port. What would you say, the minimum that somebody needs to spend to get noticed on the App Store to start building this cycle that they can reinvest in?
I don't know if it needs to be noticed on the App Store so much. So it's not like, if you're trying to blow yourself up into the hyper casual charts, yeah, sure, you need a bunch of money to do that. But you could have a game where you soft launch in Australia or the Philippines or Canada, whatever, and you could be spending just a few thousand, like a month to get some kind of early metrics and just tracking these cohorts and seeing how they're performing. So you absolutely do not need tens of thousands of dollars to try and get some early metrics. And once you've got some metrics, if they look like they're sustainable, then it's going to make it a lot easier for you to either make the investment decision, say, hey, I'm going to put bet my life savings on this now because I can see it's likely to be returned. But there's not really a sort of like a dollar amount. You can do like perfectly adequate tests on $5,000 or something like that, or maybe even less. Just totally depends on the genre of the game.
So we touched on this in the last panel with the indie publishers. Is there a spreadsheet template? Is there an equation? Is there something out there that developers can use to project this stuff once they start getting some data in, once they start getting their KPIs in and all that? Or is it still just very much, it's going to depend from game to game and it's very hard to forecast?
Well, I would point people who are tuning into this to look on pollen.vc under the calculator section, and there is the first calculator there is entitled ROAS, LTV, and cash flow. So what that enables you to do is to basically plug in retention metrics of the free-to-play game. You plug in ARPDAU, you plug in CPI or the acquisition mechanic, and then from that's you just plug in your numbers, and we're gonna build an estimated model curve and LTV for you. So we'll show you basically if you break even, and sadly a lot don't, but if you were to break even, we'll help you model out these economics. And thousands of people come to use these calculators, and we see it, because we track the number of kind of daily hits and whatever. And sometimes people will keep coming back day after day, week after week, month after month. And then all of a sudden they'll reach out to us and say, hey, we've been using the calculator to track these metrics. Now we think they're positive, and we've realized that we should be, we need to put in place a funding solution to scale it. So that's why they're there, right? We don't ask you to connect up all your data sources. We don't, you don't even need to put in an email address to unlock it. We don't even verify it, right? We just want people sort of using the tools to understand how to model these things. Have they got this investment equation that works? And if they can, then hopefully they'll reach out to us and see if we're a good fit as a way to help them finance it.
So are there, last question, and then we got to kick it over to the next one. Are there particular genres that you look for or that you stay away from? I mean, I know the hyper casual market is like ridiculously crazy competitive, but aside from that, are there certain, areas, genres of games that you are typically more excited about than others, or less excited about than others?
Well, so it used to be the case that we were more excited about the ones that would break even really quickly, right? So if, for example, you're hyper casual, these games have got like 30, 45 day break-even periods, these are the companies who would really, really help to scale really quickly, because the break-even period's really quick. And what we started doing middle of last year is we we figured out a way. We've been building these models for about 18 months that allow us to basically look at all the existing cohort data, and then to say, well, actually, for long LTV games, there can be much more money, much more of an asset in the residual value of those cohorts because they pay out over such a long period of time. So we changed our model in, I think, July of last year to say, no, we're not just going to look at the receivables that are trapped in the bank of Apple or Unity ads or whatever. We're also going to and we do this every day. We reprice programmatically the residual value that's left in the cohorts. And then if you think of a diver with 2 tanks of oxygen, they're both, they both feed into this one single credit line. So in a way, if you think about a short duration LTV game, it's basically like we wouldn't do residual lending for hyper casual because it doesn't exist. It's dead in 30 days. So it's all about receivables, but it moves very quickly. And all that's happening is we're just moving the line instead of from AR into residuals. And so longer duration games like merge games and so on, they might not have that much trapped up in their receivables, but they may have 3 or 4 times that amount trapped in the residuals instead. So we're pretty agnostic in terms of where we work, as long as the data is good and we can track the value in the residuals, then the duration doesn't matter so much.
Awesome. Martin, I appreciate it. And we dropped the link in chat. So if you missed it, it's pollen.vc. I'm not going to try to read this whole thing. Go to pollen.vc, and it's right there under the calculators. And they've also got several nice little ebooks and guides for you to get started as well. We've got our next one is on how to retain customers without resorting to crypto. So I'm going to kick it over to Dan. Martin, are you on the Discord?
I am not, but I can be. So to be honest, I'm like LinkedIn is probably the easiest way to get. If anyone wants to connect with me on LinkedIn, ping me a DM on LinkedIn. I will absolutely get back on that. That's probably easier. I find I got too many different channels. Even though I should be on Discord, yeah. I'm kind of not.
I feel you. Trust me. All right, man. Well, thank you so much for coming on and sharing all this. And we will talk to you soon. And for everybody else, stick around. Dan's coming up with our next panel in just a few moments.
Great stuff. Everybody. Thank you, Jane. Thanks for everyone for tuning in. All right. Take care. Bye.